Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Wednesday, halfway through the trading week. Welcome to Modern Investing Techniques, episode 41. I'm Patrick in Vancouver. Today is May 13th, 2026. Midweek, let's reassess this week's positions and look for fresh setups. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Mortgage rates just hit their highest level in 5 weeks, yet applications stayed positive. Canadian investors should review how rate-sensitive REITs and MICs fit inside RRSPs and TFSAs right now. North American benchmarks closed mixed. The S&P 500 finished at 7,401, down 0.2%. The NASDAQ Composite closed at 26,088, down 0.7%. The TSX Composite rose 0.4% to 34,291. Fading AI enthusiasm combined with geopolitical tensions caped Wall Street, while Canadian resource names offered modest support. Investors continue watching Bank of Canada policy signals for any shift that could affect elevated mortgage rates and rate-sensitive sectors. Normal course issuer bids let companies repurchase their own shares on the open market under TSX rules. This approach effectively returns capital to shareholders while supporting the stock price. Colliers International Group's newly approved NCIB for subordinate voting shares shows how management can signal undervaluation and reduce share count without paying a special dividend. Canadian investors can screen for TSX-listed firms announcing NCIBs through brokerage news feeds or SEDAR+ filings. They should then compare the buyback yield to the company's free cash flow generation. This approach has historically worked best in sideways or mildly declining markets where organic growth is modest but cash flow remains strong. Risks include management overpaying for shares or using buybacks to mask deteriorating fundamentals. Always verify the maximum number of shares authorized and the daily volume limits before adding exposure. This disciplined catalyst plus risk approach echoes a broader Canadian buyback tactic worth considering in registered accounts. Disclaimer: this is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. Today's practice investment is a weekly hold on AECOM, ticker ACM at the NYSE. The pick sits in the industrial sector and follows a strategy of infrastructure consulting contract wins that provide multi-year revenue visibility. The catalyst is a 5-year master services agreement with the New Jersey Turnpike Authority for ongoing capital improvements and maintenance. On the technical side, the stock trades above its 50-day moving average on the daily chart. Volume has been running near the 20-day average with no extreme RSI reading. Risk assessment points to possible contract execution or state budget delays that could pressure the name. We place an 8% stop loss below entry and target plus 2% to plus 5% over the 5-day window. Confidence sits at medium because the steady government backlog is supportive, yet the broader market risk-off tone adds uncertainty. This trade teaches how to evaluate long-term service contracts as durable revenue catalysts rather than one-time news events. It also forces discipline around position sizing and stop placement regardless of sector headlines. We will track the position through Friday and report results then. Last week's simulated weekly hold was AMD on a momentum play tied to data center growth and AI infrastructure demand after an earnings beat. Entry came at $360.31 on Monday's open. Exit occurred at $428.46 on Friday's close. The position gained 13.36% or $133.63 on a $1,000 simulated stake. The data center catalyst and volume surge delivered exactly as modeled. This confirms that requiring elevated volume above the 20-day average filters out weak momentum entries. The trade gained 13.36%, while the NASDAQ rose approximately 2.8% over the same window, producing 10.56% alpha. The Bank of Canada's weekly mortgage rate series lets investors monitor 5-year fixed and variable rates in one place. Canadian DIY investors can set calendar alerts for the Wednesday release to time RRSP or FHSA contributions into rate-sensitive REITs. The free public data feed requires no login and updates faster than most broker research portals. The quarterly Bank of Canada survey of market participants provides forward-looking inflation and policy rate expectations that can be compared against futures pricing. Active investors use the 1030 ET release to adjust duration exposure in bond ETFs or preferred share holdings. Equinox Gold and Orla Mining signed a deal to combine. The merger creates a combined gold producer targeting 1.1 million ounces of annual output and offers merger arbitrage spreads for investors comfortable with deal completion risk. Add the ticker paired to a merger ARB watchlist and size any position below 2% of TFSA assets. Global shares traded mixed as AI excitement faded and war worries persisted. This produced a 0.7% NASDAQ decline, while the TSX held positive, highlighting the defensive tilt of Canadian resource names. Trim any AI semiconductor overweight above 15% of the equity sleeve and rotate a portion into broad TSX exposure. Alphabet is the top holding of a 5-star fund that is also finding 240% gains in the unsexy side of the AI build-out. The Chase Growth Fund's outperformance versus the S&P 500 shows the value of blending mega-cap AI leaders with smaller infrastructure suppliers. Screen for similar mid-cap data center or power names on your brokerage platform using revenue growth and free cash flow filters. The simulated portfolio has completed 15 trades. The win rate stands at 47%, with 7 wins, 7 losses, and 1 break even. Cumulative P&L sits at plus $0.01. Average return per trade is 0.00%, with a best trade of plus 13.36% and a worst trade of minus 7.49%. The current streak is 2 wins. Imagine you already own a TFSA and want to add real estate exposure without buying a second property. You could purchase units of a publicly traded REIT, such as RioCan or Canadian Apartment REIT, at market open. The order fills instantly, but the distribution yield in the 4 to 6% range for many names arrives monthly and is taxed as ordinary income inside an RRSP. The mechanism that surprises most retail investors is the tax treatment difference. REIT distributions are not eligible for the dividend tax credit. Inside a TFSA or RRSP, they grow tax deferred. Direct rental properties allow depreciation claims and potential principal residence exemption on sale. A pro tip is to check the REIT's AFFO payout ratio before buying. Anything above 90% leaves little cushion for maintenance capex. Mortgage investment corporations offer another route with higher yields but illiquidity and credit risk that retail platforms rarely highlight. The biggest mistake with real estate allocation is treating your home and a REIT as interchangeable. Instead, always size the REIT or MIC position so that total real estate exposure, including your principal residence equity, stays below 30 to 40% of net worth. Before we wrap, open your brokerage platform tomorrow and compare the 5-year fixed mortgage rate series to the distribution yield of one Canadian REIT you own or are watching. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.